Hello class, welcome to my video. This video is for your Financial Accounting 1, Chapter 7, Valuation of Inventory. So what you can learn in this chapter, you can understand what is the double entry of closing inventory in your income statement and statement of financial position. Next, you can understand the relationship of the company closing inventory to the company profit or loss. Next, compute the closing inventory by using various valuation techniques. And lastly, you understand the concept of NRV and determine the correct value of closing inventory. So we start from the first one. What is the closing inventory double entry in the financial statement? The closing inventory represents the unsold purchase item during the year, and it shall not be considered as part of the purchase during the year. Therefore, it is a negative entry, we call credit entry, in the income statement to reduce the total cost of goods sold. Subsequently, closing inventory are the asset of the company at the end of the financial year. Thus, it is being recorded as a current asset, we call a debit entry in statement of financial position. So, in short, the double entry of closing inventory will be debit inventory, and this inventory is under current asset. The credit is on the cost of goods sold, closing inventory, and this is under income statement. So this is the double entry when we recognize the closing stock of a company. So this double entry is out of the trial balance, and we normally don't record the closing inventory value in our trial balance. Next, how about opening inventory? Opening inventory presents the prior year unsold item, and it will be sold during the year. So this is a positive entry, we call debit entry in the income statement. Remember the combination of our cost of goods sold? The combination of our cost of goods sold will be cost of goods sold we will base on opening inventory at the purchase during the year and minus the closing inventory during the year. And the concept of this formula I have explained in your chapter 3 video. So let's take a look. The relationship between your closing inventory and the company financial performance. If the company has a higher closing inventory, it means that they will have a lower cost of sales, higher gross profit, and higher net profit. On the other hand, if the company has a lower closing inventory, this will bring to higher cost of sale and then lower down the gross profit and lower down the net profit. So let's take a look on this formula. We know in this formula, closing inventory should be a negative amount. So let's assume if you have a higher or increase in your closing inventory value, this will lead to your overall COGS become lesser. So when your COGS become lesser, you have a higher profit. On the other hand, if your closing inventory reduce, it means that you will have a higher cost of goods sold, and this will bring to lower profit, because closing inventory is a negative item in our cost of goods sold. So this is the impact of your closing inventory in relation to the profit of the company. So just need to remember that higher inventory, higher profit. Lower inventory, lower profit. Higher inventory, higher profit. Lower inventory, lower profit. Next, valuation of closing inventory. Basically, we have three methods to use to value the closing inventory, which is first in, first out. Next, last in, first out, and weighted average. The short form for first in, first out is FIFO. We just take the first initial for the wording here, and another method called last in, first out, which is LIFO. So, according to the accounting standard IS2 have some guideline for us when we prepare the closing, when we value the closing inventory of the company. They say that we shall not use last in, first out to value the closing inventory unless for specific circumstances. It means that the best option for the accountant to value the closing inventory will be first in, first out, or weighted average. Last in, first out is not advocate. It means that we are not encouraged to use last in, first out to value our closing inventory. So let's take a look. We start from first in, first out first. What is first in, first out? Material are issued out of stock in the order in which they were delivered into the inventory, meaning that issues are priced at the cost of the earlier delivery remaining in inventory. This is a logical pricing method but can be cumbersome to operate since each batch of the material has to be identified separately. So we will go through this exercise together, classroom exercise 7.1, to understand how to compute the value of closing inventory by using the first in, first out method. So let's start. Sandy Company had 200 units of inventory at 30th November 2017, value at 800. So this is the information of opening inventory. During December, it made the following purchase and sales. So this is the transaction during the December. So they want us to calculate the value of closing inventory by using the FIFO method. So let's start. I will use an Excel to present my answer, but the overall method will be the same. So you can draw something like your T account. So this is the debt, and this is the description of the transaction, and followed by quantity, unit price, and total. So we have 5 columns on the debit, and we have another 5 columns on the credit. So in the material account, or we call inventory account, the left hand side we indicate in transaction. On the right hand side, which is the credit, we indicate out transaction. It means that the left hand side we use to record the in transaction, and the right hand side we use to record out of inventory. So we start from the opening inventory, which is your December. So this is your opening stock. What are the quantity we have? We have 200 units. The total value is 800. So total quantity is 200. Total value is 800. So from here, can we identify the unit price? How we identify the unit price? We use the total value divided by the quantity here. So we understand that the cost of inventory is $4 each. The cost of inventory, the unit price is $4 each for this batch. Next, we look at the second transaction. On 2nd of December, I purchased 1,000 units at the cost of $5 each. So this is in transaction because when we purchase, the inventory will go into our company. So 2nd on December. So we write purchase. We purchase 1,000 units. The unit price is 5 each. So we use 1,000 times 5, we get 5,000. So it means that for this batch of the product, we bought 1,000 units. The price of each is 5, and then the total value is 5,000. Next, the second transaction is on 5th. on 5th, what happened? I sold 700 units of the product. And what is the value that we sell to our customer? We sold on $7.50 each. So when we sold the product to our customer, this is in of inventory or out of inventory? The answer is out of inventory because we need to issue out the goods to the customer, so it's an out entry. So let's indicate 5th of 12th. Description, we write sold. So how many quantity we sold to our customer? We sold 700 units at the price of $7.50 each. You have to remember, in this material account, we only record the cost of the product. We only record the cost of the product. We won't record the selling price. It means that here, the selling price $7.50 is irrelevant information to us. I repeat, the selling price is an irrelevant information in our material account or inventory account because we only consider the cost. So we sold 700 units, right? So look at here. First in, first out concept means that the first item in your stock, you have to sell it first. I repeat, first in, first out. The first item that in your stock, you have to sell it out first. Alright, so we have to sell 700 units to our customer, right? So we will try to satisfy the first batch. We will try to use our first batch of the product and sell it to our customer. So the quantity is 200 here. And what is the unit price? We use the cost price. Remember, in the material account or inventory account, we only record the cost price. Alright, sales price is irrelevant information to us. So we indicate 4 here. So we have issued out the first batch of the product, but can we satisfy our customer order? Cannot, right? We cannot satisfy our customer order because customer required 700 units. So it means that we need to use another 500 units, which is from the second batch of the product. So what is the unit price for this batch? The batch will be 5 each. The cost of this batch will be 5 each. So meaning that the cost of this batch is 2005 in total. So I repeat again on the first in, first out concept. When we sold the item to our customer, we should select the earliest batch of the goods to our customer first. For example, now customer demand is 700. So we have to utilize the first batch, which is 200. And the unit price, you must follow the cost price in your inside. Okay, the original cost. You cannot follow the selling price. So this batch, we will fully utilize. Next, if the first batch cannot fulfill the customer order, you have to look at the second batch. So from this second batch, we will issue 500 units out. We will issue 500 units out, and the cost for this 500 units is $5 each. We follow the in price here. It means that for this batch, right, we sell to our customer 700 units. The total cost for this batch is 3,300, and the selling price to our customer is 700 times 7.5. The selling price is 5250, and our cost is 3,000 only. Alright, so let's continue, so you will get more familiar with the concept of first in, first out. Next, on 12th, I purchased 800 units at the cost of $6.20 each. So purchase is in the inside. I purchased 800 units at the cost of $6.20 each. So the total value 4,960. Next, I purchased 300 units of the product at the cost of $6.60 each. So when we purchase, we use the in column, 300 unit at the cost of $6.60 each. So the total is the 300 times 6.6, we get 1980. Let's continue. On 21st, I sold 400 units to our customer. This is selling price, which is irrelevant information, so we don't look at this. So now we have to have a look again in our material account. We have to identify which batch of the item that we have to issue up as the cost. So this is on 21st December. We sold product to our customer. So from here we know that the first batch is fully utilized. The second batch we have issued 500. So what is the remaining balance for this second batch? We use 1000 minus 500. It means that in this batch, we can put a remark like this. In this batch, we still have a remaining 500. So on 21st of December, customer require 400 from us. So is this 1000 is this the balance 500 can fulfill the order? I think the answer is yes, right? Because 500 is more than 400. So this 400 unit will issue based on the price of 5 as the cost. So after we record this, right, we can put a remark. The remaining stock for this second batch is 100, and the remaining stock for the first batch is 0. Next, on 28th December, we sold 500 units at the selling price of $8.20 each. Again, this $8.20 is selling price. We don't look at the selling price when we prepare inventory account. So 500. The date of selling is 28th of December. For sale, we record in the up. So customer required 800 units. So we have to find the earliest balance. So this batch we still have 100, right? So we will utilize this 100 at the cost of $5 each. So this has been fully utilized, so we delete it. And 100 definitely cannot meet the order, right? The order is 500. It means that the balance of 400 we have to utilize the third batch of the product. And for the third batch of the product, the cost is $6.20 each. I repeat, for 28, so right, first we utilize the second batch of the goods, which is 100 remaining balance, and we cannot meet our customer order, so we will use the third batch of the product and sold it to our customer. So the cost for the third batch of the product is $6.20 each. So we record in this way. So we have record all the transaction. The next thing we have to do is we have to find out what is the remaining closing inventory. So this is in, this is out. So from here we know that in is more than out. Of course you cannot out more than in, okay? In must be more than out. So you have a balancing amount on here, and the balancing amount will become closing inventory. So let's figure out what is the difference in the quantity. We use 2,300 minus 1,006. We get answer 700. So we have 700 unit. And what is the value? The value we use 8280 minus, sorry, we use 12740 minus 8280. So we find the value for this batch of the product is 4,460. So that's all for the material account in the month of December. And for the material account, actually we can do some working to check whether this answer is correct. So let's take a look. we know that the remaining stock is how much? Is 700 units. So because of first in first out, the value here 700 units will refer to the last purchase. I repeat, due to first in first out, we will first issue the item that we purchased earlier. So under the first in first out concept, the remaining stock 700 units will refer to the last purchase. So we can check our answer by using this concept. So let's take a look on the textbook. Our last purchase is 15, right? 15 on December. So 15 on December, we purchased 300 units at the cost of $6.60 each. So what is the value? We get 1980, but we have 700 units. It means that the remaining 400 units will refer to the second last purchase, which is the 800 units on the cost of $6.20. So this is 12 December. We multiply by 6.2. 400 times 6.2, so we get 2480. So we add these two amounts together, 2480 plus 1980, so we get 4460. So if you can match this answer with your working here, it means that your answer is correct. So that's all for the first video in your chapter 7. So in the next video, I'm going to discuss last in first out with you and the weighted average method with you. So thanks for watching.